Welcome to Tech Talk Tuesday. It's Tuesday, September 19, 2023. I'm your guest host, Karla, and with me today is your favorite CMT, David Blake. David, how are you doing today?
I'm doing well, fellas. Thank you.
Great. Let's jump right into it by taking a look at last week's activity and what's ahead.
Okay, well, last week we had another volatile week. We started out on Monday with the major averages having a little bit of a rally, and that was pretty much on hopes that investors thought we're still in line to have a soft landing uh, because of that, and also the fact that it was still on the table that we're probably going to have it's going to pause this week, rate hikes. So rally in the big cap technology stocks on Monday. A lot of it was led by Tesla, who had an upgrade. Someone, I'm not sure who it was, they upgraded the stock and raised the price target to $400. I think Tesla's somewhere right now around 280 or something like that. Then you also had a big spike in Meta platforms after a report came out that they were to announce some new AI tools that caused a big spike altogether in the big cap technology stocks. And then it kind of went sideways after Oracle came out and kind of disappointed in their earnings call on Tuesday. They pulled a lot of tech stocks down in sympathy with their numbers. The big story last week, we had the August inflation numbers coming out, and they just kind of showed that the inflation is going to be a little bit stickier going forward here. We had the consumer price index and the producer price index, CPI and PPI, and they both ticked higher. We've been having a nice little grind down, lower on the inflation front, but they both ticked higher this last week, mainly due to higher fuel prices. Now, the core CPI and PPI, which that's ex food and energy, which they still have to look at the regular, but the core CPI and PPI prices were basically in line, but we didn't see any improvement on that. So we had a little bit of a pullback in rates while that was going on. We did see the bulls come back in on Thursday. They tried to rally the market again. That was based on August retail sales, which showed a resilient consumer. They were up, I think, about two or three times what they were looking for. I think it was up 0.7%. They were looking for up 0.2%. So and that just kind of fed the group that believes that we're, in for a soft landing here to come in and buy stocks. Um, Actually, was on Thursday was the single best day that Dow Jones has had since early August, so that was good. And then we started getting stronger manufacturing data on Friday, which saw yields tick higher again. If the news is too good, it's going to be bad for stocks. But that just means that rates will be staying higher for longer, which can be a problem going forward. So anyway, so we come into this week. The major averages were ended up mixed. Kind of, it really didn't have much action. I think the Dow was up a hair. The S&P 500 and Nasdaq nudged lower for a second consecutive week. Nothing big, but uh, investors kind of moved to the sidelines for this week's FOMC meeting, which started today, and tomorrow afternoon we'll get decision on rates, which is expected to be left. They're expected to pause, but then we'll get Chairman Powell's press conference at about 2:30, I believe it comes out, and I think that he's probably going. He's not going to knock the market down, but he is going to have to come across a little bit more hawkish than what he might have had the August inflation data not gone higher. I think he's going to leave the door open for a further rate hike, possibly in November 1st at the next FOMC meeting. Part of that, again, is due to the crude oil prices going up. They're up for a third week, and again, they're up again today. They're pressing up around $93. So that's something we need to look at. The market sectors were mixed last week. We had some strength in utilities and also a little bit of consumer discretionary. That was mainly due to Tesla's big jump last week. And then on the week side, we had technology and industrials, which are kind of what you expect at the end of the business cycle, especially with rates staying high. So, again, as far as when the week ended, The technical condition of the market did deteriorate last week. Uh, Mainly, we had the major averages pop up to their moving averages, the key moving average resistance levels, which was the 50-day moving average, and they struggled to get through that. And on Friday, they finished below it. That's kind of a key level to watch to see if we're going to be able to move higher. And again, with yesterday and today, we're seeing the moving average just move lower. So the market's looking a little bit weaker as we go into this meeting. The technical indicators did dip into neutral to negative ground. Momentum is slowing. It's not like we're looking at a pullback of 10% or anything like this is in the cards unless we see another big spike in rates, which we'll get into later on. But we're unable to hold that the support resistance line, the 50-day moving average. Uh, this week, as we're starting to see a little bit of a pullback, you should look at the 100-day moving average, which we can look at in a minute also as the next support. Today, we saw the secondary indexes, which I like to consider that these are the indexes which will kind of lead the market higher and lower. They're having a rough day today. The small cap Russell 2000 has fallen below its 200-day moving average. That's not something we want to see. And then the transports and the semiconductor index, they both have fallen below their 100-day moving average. So that's something we want to watch. As far as the small cap Russell goes, the moving average, it's spent a lot of time this year below that level or bouncing around that. In fact, the last time it bounced off it in August. Last time the Russell was below the 200-day moving average was back in May. So that's something that we want to keep an eye on. And as today we're watching the pullback kind of picking up steam here in the afternoon, which we'll also keep an eye on. Okay, underlying breadth, we did see um, NYSE advanced decline line. It was basically flat, but the NASDAQ lost more ground. You do want to pay more attention to the NYSE advanced decline line. Karla, can we go up to the market recap and click on that and just take a look at the AD lines real quick?
Sure.
There you go. Let's go down to this, the AD line, also the high lows. Okay, as you can see on the advanced decline lines of the NASDAQ, the amount of weakness, technicians will consider uh, the AD lines is kind of a leading indicator. Again, the NYSE takes preference on that, but as you can see, it's certainly not strong. It's pulled back from the midsummer highs when we had the summer rally, and it led the market down. You know, here over the last month or two, and again yesterday and today, we're also seeing weakness in the NYSE AD line. Whether it's going to take out that low from August, and I will have to take a look. But you can also draw trend lines. A lot of technicians will draw trend lines, as support resistance on these AD lines. This is further confirmation of whether we're getting stronger or weaker. Now, right below that, you're looking at the new highs and new lows. And again, the NYSE takes preference on this. We've been since for the last month. Um, uh, Recording more new lows and new highs. That's not a market that's on its way up or getting ready to rally. That's just showing that the weaknesses across the board. We're lacking leadership. Last time you had one day last week where we were about even on the NYC for the new highs and new lows, but before that it was 2 weeks, and before that several weeks before we saw the new highs mentioned that. So that's something to kind of look at. Uh, Breadth seems to be getting we're neutral according to our sentiment index, but you are seeing a little bit of a divergence in the fact that we saw a dip in the retail bulls down to 34.4. That's below normal. The week before there, we had 42.2% retail investors. We're still bullish on the market going forward. Last week we did see a tick higher in the hedge funds. They jumped up to 58% exposure to equities, 49.7. Uh, that does compare to the average exposure for the last quarter of about 70%. So they're still kind of on the sidelines waiting to see what's going to happen with the rates. They're not they're not jumping in or loading up, thinking that they're expecting the market to go up. So as far as last week goes, what was strong, what was weak? Um, Industry groups we saw we're down to 33 hot or improving. 57 were regarded weak or deteriorating. Towards the end of the business cycle, or towards the end of uh, the cycles that we follow in the CTI and all, generally you're going to have energy stocks kind of lead the way. They're gonna be the strongest sector going higher. That kind of rotates into consumer staples and utilities as we start to see the economy contracting. And if you follow the industry group analysis, that's pretty much right on track. Last week, the strongest industry groups were oil field equipment. Again, it's energy, internet content. I think that was part of the Meta platform, probably with their jump up, and then oil secondary and coal. So the industry groups that you expect to lead as the business cycle is getting ready to stop or roll over are right now leading the way. And then on the weakest industry groups, you had medical, biotech, medical devices, airlines, and electrical equipment. So ETFs go, again, same thing. You have commodity energy and sector energy, some of the the strongest ETFs to go. And again, that's exactly what you're looking for when you're watching the business cycle roll over. Probably some different charts and all. But for right now, I think with this FOMC meeting coming to a conclusion tomorrow, we'll wait to see what Chairman Powell has to say on policy going forward. And I think it's going to be kind of lukewarm. I don't think he's going to be real pleased with wage inflation and the price of oil and stuff going up, which is kind of fighting the Fed's plan. We'll have to see what he has to say that and how the rate on the 10-year Treasury react to that's kind of what we can expect the market to do.
You mentioned that the stock market will struggle if the yield on the 10-year Treasury rises up past 4.5%. Yet we're close to that ahead of tomorrow's FOMC decision. If the Fed signals that they may be done tightening tomorrow and stocks rally, then what?
You know, I don't really. I think they're going to signal that they're going to pause, and they're not going to signal that, hey, okay, we're throwing the towel in, we've got a lick, it's clear sailing from here. We'll start to see inflation come down. We're not going to see that, especially with August data. And I'm not so sure that we're going to see they're going to be real pleased with September data also, especially on the wage front. As you can see with the airline pilots and the UAW, on strike, you're going to see wages spiked up pretty high. Now, on the other side of that, I did notice that places like Costco, Walmart, they are offering lower salaries, lower hourly wages for new employees. So that may offset a little bit, but I'm not so sure. Today, going into this meeting, uh, bonds ticked higher this morning, which is one of the reasons we did see a sell-off. A lot of people, they said that what we're looking for is anything above 435 on the 10-year Treasury. That's the resistance level. But if it ticks above that, we're going to see more selling in stocks. As we speak right now, we're at 434. I don't think he's going to be. He doesn't want to be hawkish because he doesn't want the market to go down. But if we see the 10-year T-bill yield get above this 440, it's going to require that the market come down a little bit more. Part of one of the things that we've learned over the last year is that as rates go up, it's bad for technology stocks. So if we see this 435 area, 440 area get taken out, the fact that we have the overweighting in the Apples and Microsoft and Nvidia, the big Magnificent Seven or whatever, since it's so overweighted, especially on the NASDAQ, you could see more of a decline in the NASDAQ than what you would expect on the Dow Jones or the S&P 500 just because of the overweighting of those stocks. So I think uh, when Powell begins to speak tomorrow, you just have to see how the rates are going to move. Carl, let's go to charts real quick before I wrap this up. I just want to look at a chart here. I mentioned that. Let's put up XLE. We've had several weeks here where the XLE has led the market. As you can see, with this is the energy ETF, which oil stocks, that type of thing. It's had a heck of a run up here. Now let's compare that over to XLK. Okay, now XLK is the one in dark blue, and you can see that it's struggling here since the midsummer and actually kind of working its way down again. As late in the cycle, the business cycle, energy stocks are going to lead. As you can see from once the technology sector started to roll over, energy stocks have been the leader. Um, Take out uh, XLE, make it XLP as in Paul. Okay, now once the energy stocks begin to go, as we start to see the cycle start to contract, and this isn't just me. This is Sam Stovall, who's done a lot of work on sector rotation through the business cycle. And also, John Murphy's done a lot of work on this. You see the XLP here on the bottom, kind of going sideways. As the business cycle begins to contract, you'll start to see a tick higher in this. You can draw trend lines on your chart package in here. Once you draw a line, say from that May top on the XLP down through that July August top and come on down. Once you see uh, that chart line start to break through downside resistance, that would be a sign to you that okay, we're contracting now in the economy, and that way you'll start to see food stocks, that type of thing, begin to outperform. That's when you want to look. Now also put up XLU. Take out XLP and put up XLU. Okay, you can see XLU is already starting to turn up. That's utilities. After as the business cycle economy begins to contract, the utilities will also follow energy. In this case, you can see utilities have already turned up. You can probably draw a trend line and see that we're right there. It's about ready to break out to the upside. Those last two are the areas that you want to start to look at. Maybe put in some stocks in your stock watch list, or you go to your industry group, and when you see some of the consumer staples uh, industry groups begin to get upgraded, you'll find some stocks there. Those are the ones you want to start to see as you start to see the rates stay high for longer, and then as the economy begins to slow down, you'll start having people talk about rates coming down, which is not going to happen by the end of the year. Uh, don't even think that. Uh, Maybe towards after the first of the year, maybe towards May area, maybe something like that, you might see something begin to take down. But at this stage, go to your charts, make some lists up out of some of the consumer staples and utility stocks. I think you'd be chasing the energy stocks right now. They've had a heck of a move. I think they're up something like 25% since June. That's a little bit too high over that time period to still be chasing oil related stocks. In fact, I think that once if you get closer to 100, I think that would probably be where they peak out, and then you start thinking about, maybe do I want to lock in some profits on these oil stocks that I have, your Chevrons, that type of thing. We have to see. But anyway, again, going forward from here, we'll take a look to see what Powell has to say tomorrow. He mentions that we're going to leave rates higher for longer, and he's going to leave the door open for a November rate hike. Should benefit utilities and the consumer staples going out over the next month or so, and that would be where I would look for ideas. By the time we get around to that, then we'll start talking about what sectors would follow that. Again, tomorrow, just keep an eye on that yield of the 10-year Treasury note. Uh, if it comes down for some reason, if he's dovish, and we start to see a dip in the yields, you might get a 1 day, 2 day rally until reality sets in. But if he's a little bit more hawkish and you do see that 10-year yield go above the 440 area, you're probably going to see more weakness in stocks going forward over the next couple of weeks. That also coincides with our CTI, our timing model. We're looking for the 18 week uh, cycle to be bottoming here, which probably could happen over the next couple of weeks also.
Great. Well, a lot of great information. Is there anything else that you'd like to add for this week, David?
No, let's just see. Let's get through tomorrow afternoon, and perhaps next Monday we can talk about what we're going to see, depending on what Powell has to say.
All right. Well, that wraps up today's Tech Talk Tuesday. Thank you for listening. And as always, if you have any questions, feel free to contact us at the chat box located at the lower right-hand corner of your screen. Thank you again, David, and we'll see you next week.
Thank you.